Hi, this is Mike Larson for Money and Markets TV. Wall Street has had a serious case of buy the rumor lately, with the Dow tacking on more than 1,200 points amid multiple reports of alleged bailout programs. Now first, you have a scheme to leverage up the European Financial Stability Facility. Next, a plan to change the 440 billion euro fund to a bank so it can borrow money from the European Central Bank. And then, some half-cocked idea to shift the European Investment Bank's focus from planting trees in Spain to buying billions of euros worth of Spanish sovereign bonds. But now we're getting to the point where rumors just won't work anymore. Investors want to see real, concrete steps to solve Europe's debt crisis. And unfortunately, as I've been telling you all along, there is no easy solution. Debt write-downs, multiple bank failures, the expulsion of some countries from the euro, or even the possible disintegration of the currency entirely are what's needed to finally put the crisis to bed. But that's incredibly painful. So global policymakers have only one option, and that's to keep trying to stall and baffle the world with rumors even as the underlying crisis gets worse and worse, and we tumble ever closer to that fateful Lehman Brothers moment. Take this past weekend's gathering of finance ministers and central bankers from the G20 nations. It was supposed to usher in some new major concrete push for international cooperation, and that's why the market ripped to the upside last week. But all we got was another plea from G20 officials for Europe to, quote, decisively address the current challenges through a comprehensive plan. Not only did we not get a plan, we actually got one major rumor shot down. That rumor was that the BRIC countries, Brazil, Russia, India, and China, would pitch in to help bail out the International Monetary Fund. And then the IMF would use that money to help bail out Europe. But it turned out to be yet another desperate gamble by Wall Street to goose the markets. In actuality, the IMF swatted down the idea repeatedly, according to the Wall Street Journal. Or what about the idea that the EFSF, or the equivalent of TARP in Europe, should be turned into a bank? Turns out that rumor was also bunk. The new plan is to turn the EFSF into an insurer of sorts. It would insure investors in European sovereign bonds against some percentage of their losses, which would supposedly encourage them to run out there and buy those bonds. But that's what companies like MBIA and Ambac Financial did with a bunch of lousy mortgage bonds back in the 2000s. Their insurance wrappers helped boost the ratings on those securities to AAA. But because the credit quality of the underlying bonds was so awful, the insurers blew themselves up. And now we're supposed to believe the same harebrained scheme will work with a bunch of lousy sovereign bonds? Especially when the countries backing the EFSF, like France and Germany, are themselves in danger of losing their AAA ratings? It just doesn't make sense. In fact, just this week, Moody's warned that France's AAA rating was coming under increasing pressure. That's a potent reminder that it can't afford to come to the rescue of both its own troubled banks and the rest of Europe's troubled sovereign countries. Finally, there's the whole issue of the ever-rising costs of bailing out Europe's problematic countries. Greece got a 110 billion euro bailout in May 2010, but it wasn't enough. So the country needed another 109 billion euros this July, and now that's proving inadequate, and an even bigger bailout's being discussed. Folks, if things are this bad in Greece, how in holy heck is Europe going to be able to keep bailing out Ireland and Portugal? Or Belgium, which is now seeing its interest rates and default swaps surging too. Or Spain, which was just downgraded 2 more notches by Moody's. Or the granddaddy of them all, Italy. It's the third largest issuer of sovereign debt in the world, with 1.59 trillion euros of sovereign bonds outstanding. The reality is that there just isn't enough money sitting around to bail out these behemoths. And that's why European officials are already trying to dial back expectations for this weekend's summit of European leaders. Germany's Angela Merkel warned earlier this week that, quote, dreams are taking hold again now that with this package, everything will be solved and everything will be over on Monday, end quote. At the same time, the country's finance minister said there will be no definitive solution coming out of the summit. Private bankers are also pushing back big time at calls from government officials that they raise more capital at a very high cost to their shareholders. Bottom line is that the markets are going to continue to be buffeted by rumors and innuendo on any given day, with big rallies and big sell-offs increasingly common. But the long-term outlook remains bleak, given these huge debt challenges that Europe faces. I'm Mike Larson for Money and Markets TV. Thanks for watching.